Okay, the first rate's then on your screens, and it's a nice positive start. Seems like once again we're going to at least attempt a dash at that 19,500 print. Although I must say that we're not as exuberant as the pre-open rates were, a lot more tempered from there. I want to check in on the IT majors. Let's see what TCS is up to and whether, and rather how the street is absorbing those numbers and the commentary from the management. Not bad at all. Even though the numbers were muted, it was in line with expectations. The street is actually, willing to give the management the benefit of the doubt and going by their words that maybe things are going to look up, at least in the medium as well as the longer term, whereas the short-term uncertainty continues. While the Nifty IT index is flat, HCL Technologies is not. Those earnings have managed to miss the street estimates. They see FY24 guidance as a challenging feat, and you can see that play out on HCL Technologies. Wipro ahead of its numbers, absolutely quiet, about 0.3% is where that stock is. Now let's look at what Patanjali Foods is up to. They've launched that OFS. It's at a discount at 1,000 rupees, 5% lower for Patanjali Foods, and you will see some more drag come by on that stock price. SpiceJet, promoter Ajay Singh is looking to infuse 500 crore rupees into the airline of his personal money. Gap up start for SpiceJet right now, 6% higher is where that stock is. Couple of earnings reactions other than IT. So Anand Rathi, the profit has risen about 24.6%. AUMs are higher by 11% on a sequential basis. There's 5 paisa as well, wherein there has been a margin expansion to about 23%. The number of clients has seen an uptick of about 3% on a sequential basis. Stock holding up by 4.25% as we speak. There are a lot of other pharma majors as well, which are in news this morning. So just take stock of what DRL is up to. They've got the biosimilar application for one of their key drugs, which has been accepted for the US FDA review, but you're not seeing much excitement on this stock. Lupin, wherein the US FDA has issued Form 483 with 2 observations for their Nagpur unit, that should be seeing some sentimental drubbing. That stock lower by 1% as we speak right now. There's Dreamforks as well, which has announced a strategic collaboration with the Plaza Premium Group. So that stock has gapped up 6%. Now let's take stock of all the movers from yesterday. I want to see what Delta Corp is up to after that massive selling that the stock saw yesterday, and some of the marquee names as well selling into that stock. Delta is seeing a bit of a dead cat bounce, if you will, 1.25% higher. I would say these are just early days yet. Let's see what direction the stock takes maybe half an hour from now. The big movers yesterday were the likes of Piramal Enterprises and Piramal Pharma. Piramal Pharma, of course, had a brokerage upgrade as well coming in. Today, too, you are seeing some of that momentum continue. And the entire OMC pack, with crude now at 80, that may not be auguring all that well on that entire OMC pack. So just look out for what some of these names do. Ajay, anything else that you're spotting?
In fact, even the metal counters should, deserve some attention, because the dollar index coming back to almost 1-year low. And the top gaining stocks, of course, we are looking at Tata Steel, JSW Steel. All of them are gaining almost 0.5% in trade because of the dollar index impact. Not only that, Reliance Industries. Now, analyst community have worked out the reasoning behind the 1,400 rupee almost valuation arrived for the retail business, but 2,800, nudging that mark, is what Reliance is trading at. Look at IndusInd. There's some positive commentary by the brokerage community on IndusInd valuation, especially in light of promoters wanting to hike their stake to 26%. Look at that, almost 1,400 there on the IndusInd stock. Let's take some opening trade ideas then. Kunal and Nuresh are here with us. Kunal, what are you spotting right now?
So a lot from the large cap and mid cap space. In fact, BHL is something which I would recommend, but L&T is also one of the stocks which looks very attractive. I think now the stock has come back towards a 3-day swing low. So that's from the large cap space, which looks very attractive for a fresh bet at current levels.
Okay, and Nuresh, let's get in your take. Just checking out the screen this morning, what's your assessment on the index at the current levels, given the fact that it has been in consolidation mode for the past many days? You were talking about that. So what's the first trade then that you're punching in? Nuresh, if you could unmute yourself.
Yeah. Not looking at the index, there is better risk reward opportunities in the broader market. So Biocon looks interesting. The stock is setting up for a fresh trend, looking at it to go towards 280 levels. So buy at current on levels on Biocon.
Right. All right, let's take it forward on the fundamentals then. Manish Gunwani is here with us, CIO at Bandhan Mutual Fund. Manish, good to have you. Nice to see you in your new role. My best wishes. So let's start our discussion with the most spoken about sector this morning, that is IT. It is interesting to see that it's not taking incremental knock in trade. But for the moment, if you would have just read the commentary that at least from TCS saying hardly any visibility for the second half, all of that, even HCL Tech commentary seemed to be suggesting that things are not looking that rosy yet. But the street had started accumulating those counters. What's your positioning on IT? Would you be a buyer from any weakness from here on?
So overall, we're still underweight IT. The thing is, I know from a free cash flow perspective, these stocks are looking incrementally attractive. But the thing is, we still haven't seen how big and deep the US slowdown will be. The second is, if you take on a 4-5 year basis, the valuations are not necessarily distressed cheap. They've corrected a lot in the last 1.5 year. But it had been one of the best performing sector from 2017 to 2020. So if you take long-term valuation stocks are not necessarily very, very cheap. And thirdly, we're definitely seeing the dollar under a lot of pressure. And there is a possibility that if the dollar remains weak for some time, and we see a fairly extended period in which rupees stays flat or may even appreciate, and then I think the pressure on margins is likely to build up. So given all these positives and negatives, we still think on balance, underweight still makes sense.
Okay. So most undervalued, or rather, you're negative on IT still right now, Manish, but where would you say that there is value on the table and that sector should be bought if you spot anything right now?
So I know, again, that the domestic cyclical sectors like auto, financials, industrials have done well. But I will just think that the momentum in the domestic economy is likely to be much stronger than the global economy. So from a broad top-down perspective, our view has been that the domestic facing sectors will outperform the global facing sector like IT and chemicals. So to that extent, we still are on that theme. I know the valuations have become more expensive in the domestic sector and relatively corrected in the global sectors. But clearly, I think one of the most fundamental drivers this year is the trajectory of the dollar. As we've seen, it has corrected almost 13-14% from the top, the dollar index. And I think a lot of the strength in the dollar has accumulated over the last 10-12 years. And while macro forecasting is always risky, my hunch is the dollar is likely to remain weak. And in which case, as I said, the export sector not only will have a top line issue, but I think going forward, it could be a margin issue as well, because if the dollar is weak, your realizations obviously suffer.
You seem to be bullish on the domestic stories here in India in the economy. What about PSU banks? We are seeing early sparks of a second round, which is starting in the PSU bank space. After 2-3 good quarters, they went sideways. Despite of good earnings, the market was kind of ignoring them. Are they back at attractive valuations to nibble in, PSU banks, especially the mid-tier ones?
So again, our exposure today is much less than, let's say, a year back. And the logic is this, that clearly we are in a situation where the global economy can slow down from here. That will have an impact on the Indian economy as well. Now, banking as a sector obviously has again done well last 2 years. If you see the aggregate ROE or ROA of the sector, it is almost at a decade high. And in that scenario, not only with banking, I think across the market, we're trying to remain in slightly higher quality names within each sector. So yes, we think the domestic cyclicals are attractive versus global cyclicals, but within the domestic cyclicals, I think you need to be a bit more selective. See, from COVID bottom, obviously, almost every cyclical is done well, but going forward, given that um, there is a lot of uncertainty about how deep the slowdown in the global economy is going to be. And we cannot deny the fact that if the global economy has a deep slowdown, even the uh, domestic economy will get affected. So if, let's say, global GDP growth comes down to 2% or below, which is believed to be a recessionary kind of scenario, then India's growth will also get affected, in which case you want to be in a bit of structurally good companies, the companies which have better technology, better management, etc. So in that sense, while PSU banks still deserve a weight in the portfolio, I don't think we believe that it can't be very high weight in the portfolio.
Manish, talking about homegrown sectors, there is this whole thrust about manufacturing. Everyone's obsessed with this theme in the market. And, two of the sectors that I want to pick upon is defense and railways. I wanted to understand from you, because, you'd have a better sense on this, whether are we reaching the cusp of over-ownership now in these sectors? And would you say, at least in the near term, the best is behind us?
Definitely, I think the in terms of returns, I think the best is behind us because these stocks have done phenomenally well. They came off a base where people or investors were very under positioned in those sectors, and we've clearly seen that as the top line growth has come through in defense and railways, there's been a massive re-rating of valuations. Now, I do think that there seems to be a very strong policy focus on these segments, and there can be a multi-year cycle. A lot of it is priced in, but I think also one needs to be a bit careful about the government budget dynamics because the government wants to consolidate fiscal deficit. They've said they want to go from 5.8 to 4.5 in a couple of years in terms of fiscal deficit. And if that were to happen in an environment where commodities are weak and nominal GDP is decelerating, see, the government accounts are such that you have a lot of committed expenditures. So if your overall expenditure is going to grow at 7-8% and the committed expenditures also grow at that rate, there will be some pressure on the discretionary expenditure. And therefore, you need to be a bit careful about that dynamics. So if there is too much of deflation globally in commodities, I think you need to be careful about how strong the government spending will be, which directly impacts these kind of sectors.
Manish, if I was to just look at your activity in the market, it appears that renewables is an area which interests you. You seem to have added some names out there. And among the, which side of the renewable story would you log on to? The generators, some of the capital goods provider around it, or the transportation companies like transport towers and all of that? How would you play the renewable piece?
So yes, in general, starting with that overall call of domestic, preferring domestic over global, even in capex, I think very broad-based capex is unlikely to be strong, particularly because a big part of capex is the commodity producers, the upstream players in commodities. So, which are basically your oil exploration and production companies, your steel companies, your refining companies, all these segments, which typically are a big part of the capex piece, given where commodity prices are, given what's the outlook on China, it's unlikely that, unlike 2002 to 2008, where we had a very broad-based capex theme, I think it's going to be a bit selective this time. And in that sense, power being a pure domestic good or service is essentially, I think, somewhere where we've seen many years of underinvestment coupled with the fact that you need to transition to a better carbon regime kind of technology, which is renewables. So you both have a demand supply mismatch as well as a big technology shift. And therefore, I do think that there can be fair amount of acceleration in investment in power itself, particularly in renewables. And because renewables generate power more volatility, there needs to be, as we've seen in Europe and other places, that your grid investments also need to go up because you will have power being very volatile during the year or during the day because of renewables. Now, clearly, we will see investments across the value chain. So you can play utilities, you can play the capital goods which cater to renewable power. You can play the transmission and distribution equipment suppliers. You can play the EPC companies which build up these infrastructure. So yeah, there are various pockets to play. I think various funds are playing it in a different way. But the entire value chain, I think, is definitely interesting.
Manish, the other area of the market which seemed to be turning around after a decade of almost underperformance is the NBFC space, right? And the one which catches my attention, you guys have added, is the most bombed out NBFC out of the lot, which was so tilted in favor of wholesale. People had forgotten.
For the viewers.
Well, it's the hint is enough, but it has come back. It has come back. If the quarter gone by is any indication, now their wholesale to retail stands at 50-50. Do you think worst is over for wholesale kind of NBFCs and now they're looking upwards?
Yeah, I guess we slowly have to start building for a scenario where interest rates are going to come down because if you just see the shape of the US bond yield curve, it is so inverted. And while bond yield curves may not be the right forecaster of how interest rates go, I think you have to pay attention to them. So clearly, we are broadly expected to be in a scenario where going forward, US interest rates in a year or 2 years will be materially lower than where they are today. And if that is the scenario, obviously, whatever Fed does, it kind of flows across the world, right? So I think globally interest rates will be lower, 1 to 2 years lower. And the other point is NBFCs, by the definition of being wholesale, are very dependent on liquidity. Now, as we discussed, if we believe that the dollar has already depreciated a lot, which tends to improve liquidity globally, and the medium-term drivers of dollar, which is interest rate differential or the fundamental value of the dollar, I think they are pointing to a continued weakness in dollar. So liquidity is good for NBFCs. Falling interest rates are good. And the good part on the asset side is the domestic economy in terms of autos or infrastructure. There is very little at this point you can see where you can say that there'll be huge asset quality issues in terms of giving out loans for houses or autos or infrastructure. So you have a scenario where both the sides of the balance sheet are likely to improve. Valuations again, meaning last 1 year they've done well, but again, if you see on a 5-year starting from the ILFS crisis, it's generally been a very mediocre phase for them. So they're coming out of a fairly long cycle of mediocre valuations. So yeah, net, I do think that they present a broad, attractive risk-reward space to play in.
Right. Okay, Manish, so before we let you go, just a quick word on which do you think is the most undervalued and overvalued pocket in the market?
So I think the matrix of being domestic and small cap, I still think is the space to be. I know it's not a very precise answer. The reason why it's not precise is, as I said, that if you're not expecting broad-based global growth, and if you're not going to see Indian growth also surprise to the upside, I think India will be resilient. But if global growth is going down, you can't expect India's growth to accelerate. In which case, in every sector, I think you will have to find the company which is getting market share. So there are a whole host of domestic sectors. But more than saying this sector versus the other sector, I think it's about finding those stocks, because the whole sector is not going to grow at a supernormal rate, right? So I think more than a sector, it's first the domestic part, and then within that, finding that small company which can get market share and grow earnings and mid-teens to 20% plus for next 3-5 years. I think that's the best strategy to play.
Manish, great to have you on the show today. Thank you so much for taking the time out.
Thanks for having me.
Okay, before we move on to our next guest, I just want to bring up some of the stocks in trade for you. And guess what? The face of the indexes changed from today, given that HDFC ceases to exist as a listed entity as of today. So I just want to check in what LTI Mindtree is up to right now in trade. And of course, what is it that you're seeing on JSW Steel as well? Those two cases will just come up for you on your screens. HDFC Bank, of course, that's holding up nearly about 1% or so. Next up, let's take stock and let's talk to our management and talk about how the global shipping industry is actually panning out. We have with us G. Shivakumar, the CFO and ED at GE Shipping, joining in on the show right now. And who better than him really to give us perspective on not just shipping, but what's happening with the global world market as well, or businesses and economy. Mr. Shivakumar, great to have you today on ET Now. Thank you so much for joining in. I firstly want a macro picture from you, because what we understand from ground zero is consumers reducing their higher goods spends against this entire backdrop of the global economy reeling from the inflationary shock. Although yesterday, both India as well as the US print for inflation has softened a little bit, but it seems that demand is, still a little bit on the somber side. Consequently, spot rates on major trade lanes also have tumbled, as we understand. Help us understand and really paint the entire global macro picture for us. What's really going on outside in the world?
Yeah, so good morning and thank you for having me. So our business deals with bulk commodities. Some of the consumer demand that you referred to is for finished goods, which we don't transport. But let me give you the view from the perspective of bulk commodities. And the biggest one of all, of course, is crude oil, which is a consumer-driven demand in a lot of the refined products. Gasoline demand has been pretty strong overall year on year. Jet fuel demand has also grown. While it's still below pre-COVID levels, it's grown pretty well between 2022 and 2023. So those two commodities are being consumed and there is growth in demand for those. In the oil space, there is, of course, diesel, which is more of an industrial commodity. And demand for diesel has been pretty soft over the last, in this year versus the previous year. So that's where we are seeing a little bit of weakness, but the consumer-led products seem to be doing fine. So from the tanker market point of view, that's what we are seeing. In dry bulk, we are seeing, and dry bulk is mainly a China play, and dry bulk, again, is not necessarily a consumer commodity. But coal demand has increased, especially India and China. So coal trade is up. However, Chinese property market is still very subdued. New property starts are very low. And people keep talking of a stimulus there, but there's no sign of that stimulus. And therefore, steel demand, while it's growing, has not been very strong. So that's how we are seeing it from the point of view of the bulk commodities.
Right. Mr. Shivkumar, sir, whenever I see you, I remember that legendary comment by you that we behave like fund managers, allocate capital at a time when nobody is actually looking at, and you have created capacity. So now their crude is back at 80, and strategists globally are saying that US may not actually have such a bad landing. It may actually have a soft landing. And if that is the case, if we look beyond the 6 months, 6 to 8 months, companies such as yours would be in a great spot, because we would be talking about sharp normalization of global commodity usage and overall the world coming back.
That's correct. I think the conclusion that you're drawing is correct, and thank you for your remembering our philosophy, which I mentioned to you earlier. Yes, we think that that the demand, if it comes back, will come back in a big way if the market normalizes. For instance, if you just get back to normal, aviation fuel demand, which is back to pre-COVID levels and growing from there, that's going to be a big increase in demand for oil. And then if you get normalized demand for diesel and other commodities, other refined products as well, yes, the oil market can get pretty tight, especially in view of all these OPEC cuts which have happened in recent quarters. And then the market could get tighter. The oil market could get tighter.
Mr. Shivakumar, hi there, morning. Let's also understand your outlook when it comes to, the kind of green shoots that you had mentioned were available in the dry bulk segment. There was a spell of softness with the China steel production and even the iron ore imports going up. Are you seeing a turnaround taking place anytime soon?
Not yet. We are not seeing it yet. We've seen increases in imports into China year on year. However, most of those imports have come from short haul routes. You know that for us, for shipping to do well, you need the cargo to travel for longer distances. Here we've had most of the increases in, say, coal imports into China coming out of Indonesia, which is a very short haul, rather than from, say, Brazil or even Australia, which is a longer trip. So yes, demand is increasing, but it's not increasing enough to tighten the dry bulk markets. It is not yet increasing. The one trigger that you can have is a normalization of demand in China or a big stimulus towards the real estate sector in China or an infrastructure stimulus.
Right. Mr. Kumar, if we were to look at your philosophy, your cash flows are likely to improve very sharply in the next 1 to 2 years, if last few quarters are any guide, because you have, it's already showing, and plus you have extra capacities if things accelerate from here on. What would your capital allocation policy be? Because at such an elevated market, you would not add capacity, right? You add capacity in lean times. So are you going to do a buyback and improve your ROEs, or give back big dividends, or improve your dividend payout ratios such healthy, or you'll retain it back on your books?
So first thing is, on the dividends, we paid 28 rupees 80 paisa last year, which is the highest dividend we paid in any year, almost twice the previous high. So that's one thing. And we do believe that if you make a lot of money, you should pay out a significant portion of it to the shareholders. The second is the high rate. So tankers are at very high asset values. Dry bulk has come off a little bit. It's probably come off about 20% from a year ago levels. So it's getting closer to the levels at which we could think of buying, because the market has been weak. Of course, it's not come down a lot to the levels that we would say that, okay, here we are there now to commit a huge amount of capital, but it's getting closer to those levels than it was, say, 3 to 6 months ago. So we could think of allocating capital there. We are ready to buy ships if the prices are right. So, the money is sitting there and waiting to be invested. All options are on the table. You mentioned a buyback. Again, we are value investors, whether it comes to ships or to the stock. You know that, and I think I mentioned it earlier, there is a big leakage in the buybacks, which is the tax which has to be paid by the company when doing a buyback of shares. It's a 23% leakage. So it makes a buyback extremely inefficient. That's one of the things that we have to take into account when we are considering a buyback, because of the cost implication of that. But all options are open. And, as I said, dividends, we've paid out higher dividends. And we will look at all options of capital allocation. For us, buyback is also a capital allocation tool, really.
Right. The other thing I wanted to also talk about, Mr. Shivakumar, and please correct me if I'm wrong here. Your order book as a percentage of your fleet remains low, especially for crude tankers. When do you actually see a meaningful improvement coming in? And when do you see the supply side tightness easing?
Yeah, so we are already seeing, you're absolutely right on the order book being low, the global order book for new ships being low for crude tankers. It's building up as we speak, still not a big number, but every week we see orders going in for new ships. So it is building up. It is restricted by yard capacity because for the next 2 years, yard capacity is taken up mainly by container ships and by LNG ships, and those are the slots which normally are used for building crude tankers. So, but slowly we can see the order book building up, though for delivery in 2026 and not in the short term. So those ships will not be coming in within the next 2 years. This is the normal market correction mechanism. The ship owners have got money. Slots are available, though they are available only 3 years down the road. So they will, orders are being placed. But even though that order book has not built up still to double-digit numbers, the typical order book long-term has been maybe 15% of the current fleet. You're still at below 10% of the current fleet in both crude tankers and product tankers and dry bulk, actually. But orders are being placed. It is building up as we speak, so not in a huge way and not for the short term. So for the next 2 years, we know exactly how many ships can join the fleet.
Appreciate your time. Thank you so much for joining in and walking us through your business updates. Well, it's all smiles and there's nothing but fireworks on the screen because right back we are at those fresh record highs. So yes, indeed, the print of 19,520 plus is on the screen, 525 plus. And hopefully, Ajay, we should sustain around these levels, fresh record highs on the Sensex and
guess
Nifty.
what, Tawan? I mean, at least I am surprised. You know what? The top three gainers on the index are among IT companies. Infi, TCS are gaining almost 2% in trade.
TCS is up 2%.
Percent. That's exactly my point. So all the negatives that you were talking about were already factored into the price. Autos have come back, M&M, and of course, because the dollar index, we are also looking at metal stocks come back. So there's hardly anything apart from, say, an odd Maruti or HCL Tech, almost everything. Massive advance decline in tilting in favor of advances. Kunal, Nuresh are back. Guys, look at how IT has come back and contributing to the Nifty gains, which is crossing that 19,525 kind of hurdle we saw last week. Kunal?
Well, yes, Ajay. In fact, you rightly pointed out that it's the participation from the IT stocks this time around, which has led to the index moving up higher. And this is the beauty of the markets in the last 4 months. We've seen that every sector, in every phase, it's played like a relay race. So initially started off with auto stocks doing pretty well. Then you had the private sector banking names, especially the mid cap end, which started to look a lot more attractive. Metal stocks, real estate names, they have done phenomenally well. Infra stocks, capital goods, they had their own fair share of strong price uptrend. And now the beaten down sectors or the underperforming sectors like the IT and the metals in the last couple of days are making a very strong comeback. So I think this is a classical sector rotation play which is going on the index. I think that's one of the major reasons why we are not just crossing over the life highs time and again, but I think we are sustaining those higher levels and trying to consolidate at those higher levels every now and then.
While IT, it is all the way. TCS is the one which is actually leading the ship. There's, of course, Infosys, 1.6% higher there as well. And, there are other heavies as well which are doing the bit. And look what's happening within the metals pack today. Hindalco is your top mover on the index, holding up 2.5% right now. There's Tata Steel as well, which is looking pretty strong. And then, of course, there's Reliance, less than 1% higher. But at least it's doing its bit and participating in this move today. And HDFC Bank, now that it's flying as a solo entity, HDFC Bank combined, that is holding up 0.7%. Nuresh, on the two mighties, Reliance and now HDFC Bank.
So we are seeing this shift in terms of leadership coming back. We are seeing IT bouncing today. Reliance Industries is now at a new 52-week high. The stock is not far away from an all-time high of 2850, 2880 levels. So the stock looks interesting and strong. HDFC Bank is the critical one going forward because that's a stock which has not performed for the last 2 years. Also, 1730 has not been able to be crossed, but 1600 does not break. So out here, this could be a stock which could be going forward leading the index whenever the index has to make a further move. So HDFC Bank looks interesting at 1600, 1650 to accumulate. I would eventually expect it to cross about 1730 levels also.
Okay, indeed, it is a pretty strong momentum that you're seeing build up on D Street, as you've got IT and pretty much all the sectoral indices that are supporting the markets at the current juncture at those fresh record highs. All right, let's get a move on then and connect with the management of Century Plyboards to talk a little bit more about their business outlook. We've got Keshav Bajanka, who's the executive director, joining in. Keshav, thanks so much for taking time out. Let's just talk a little bit about the outlook on these upcoming range of laminates, what kind of R&D has gone into it, and how is it unique from what you currently have?
Good morning. Thank you for having me. I think, our objective has always been to be innovators. We try to set the trends. We try to do something a little differently. And if you look at a laminate, till now, a laminate was, of course, a branded product. But, you could not feel the benefit of the brand once it is installed. So we wanted to make it a designer branded product. And towards this end, we have tied up with perhaps the largest name in fashion in the country, Mr. Manish Malhotra. And we have launched a range of laminates that is Century Laminates by Manish Malhotra. So I think this is a very, very positive step. And we are the first in the world to actually come up with such a collaboration. So we are very bullish on the same.
You have announced a 2,000 crore capex in the coming years. Clearly, the visibility on ground appears to be very good. Talk to us the breakup of this.
Firstly, the future for the country is looking very, very bright. I think India is one of the economies that today is leading growth globally. So this 2,000 crore capex shows the belief that we have in the potential to come. The breakup, a large chunk of this is towards MDF and particle board, because these, as you know, are high capex industries. So in MDF, we are coming up with a new unit in Andhra Pradesh at a cost of 600 crores plus. In particle board, we are coming up with a unit in Tamil Nadu at 500 crores plus. Other than this, we are investing in all segments. So we are investing in a new factory in plywood, we are investing in a new factory in laminates, and we're also investing in ancillary businesses, for instance, PVC boards. So today we are investing in all the sectors we are present in, but the bulk of the investment is going towards the new generation products, MDF and particle board.
Keshav, across the board, what we are witnessing is that there is a demand from the premium luxury segments, right? Consumers are upscaling across the board. I mean, be it cars, be it homes, just about anything. Are you witnessing that in your business as well?
Yes, I think, there's a mixed trend, because while the higher end segment is doing well and the recovery has been very good post-COVID, and ever since COVID, we have seen the same. For us, we have now entered into the lower category segments as well. We've entered into the economy markets through our scenic ranges, and even that is doing well. So I wouldn't say that for us, because perhaps we weren't in the belly of the market, so to speak, earlier, we're doing well in that space as well. But definitely going forward, I am very bullish on premiumization. Again, the Manish Malhotra range is going to be an exclusive range that is towards the premium end of the segment. So that shows our belief that this segment is also going to grow, and the early signs are very positive.
Keshav, if you look at 12 to 24 month far out, and also maybe beyond, when this capex actually starts coming on stream, what would your segmental breakup look like? Up till now, the 60% is plywood, particle board 4%, laminate 17%, MDF 17%. How would it kind of go through a change?
That's a very difficult question, because while there will definitely be growth in MDF and particle board, plywood segment is doing well. And in laminates, with the new growth levers introduced, we're looking forward to robust growth as well. But yes, there will be a transition towards a higher percentage in MDF and particle board, just simply because of larger capacities. Our capacity in MDF till earlier this year was 600 cubic meters. As we stand today, our capacity is 950 cubic meters. And by the end of this year, this financial year, our capacity will be 1900 cubic meters. So when you're going 3x in capacity, then definitely it's going to be a faster trajectory. But the shift is difficult to quantify, because we're growing right across.
Okay, fair enough. Just wanted to also talk about the outlook then down the line in terms of, your overall market share and how you're looking at any more collaborations? Are there any partnerships or perhaps any acquisitions in the foray?
We are a company that prides itself on always being on the move and always thinking. So we are exploring quite a few opportunities, and hopefully we will be able to disclose some of it very soon. But at this point in time, all I can share is what we have just done. And going forward, yes, we are on the move. We are seeing a lot of opportunities. There is tremendous potential, and I think we should be able to get back with some news in the very near future.
Great to have you on the show today. Thank you so much for taking the time out.
Thank you.
Okay, let's just move on and let's revisit the markets right now. In tandem with the rest of the globe, we're actually scaling a fresh high this morning. While, of course, TCS Infosys are powering ahead, Hindalco is doing its bit. There's also Reliance, HDFC Bank, M&M, Britannia. They're all scaling fresh highs for themselves. But look what's happening within the broader end of the market. And it's quite interesting. While it's TCS, yes, a reaction to its earnings, and Infosys is following suit. It's pretty much the same story across the mid-cap IT segment as well. Look at the move on Persistent, for instance, right now, and if we can just bring up the intraday graph there, it's a solid 2.6% move that you're seeing. Intellect as well is holding out. So IT across the board is seeing green right now. LTIM, Coforge, LTTS, Emphasis, TechM, barring HCL Technologies, which also, by the way, has recovered from the session lows. It's down now only 0.5%. Intellect, Wipro, ahead of its numbers, Birlasoft, the entire sector is holding out. And look at the smart recovery, which has actually played out on HCL as well. But we were talking about Reliance too, so let's address that one because they've decided to reduce the share capital of its step-down subsidiary, that's Reliance Retail. Shareholders whose holding will be affected will now be paid 1,362 rupees for every share that they hold. So how is this going to really work out? And how is it that they actually derived at this particular price of 1,362 rupees? Samit is here to give us perspective on all of this. Samit?
Well, the share reduction of Reliance Retail was one of the most talked about things over the weekend, and as per the latest disclosure, we are now understanding how has actually Reliance calculated or arrived at a value of 1,362. Now, as per the latest disclosure, what we are understanding is that the equity base of Reliance Retail stands at close to 899.5 crore shares, and of this 99.91% stake is owned by the promoter, that is Reliance Retail Ventures, which means that they are buying back 0.09% of the equity. On the valuation front, they had appointed two different valuers, ENY and BDO. ENY came up with their valuation of around 884 rupees per share, and BDO had a valuation of around 849. Now, ENY in its report also mentioned that the brokerages are valuing Reliance Retail at 794. So out of these three values, Reliance Industries chose the highest value given by ENY, that is at around 885 rupees. But still, they are paying Reliance Retail shareholders 1,362 rupees. So why is this 477 rupees extra that Reliance Industries is paying? Now, Reliance Industries completely understands that if they pay 885 rupees per share to a small shareholder, they'll have a tax burden on it. Hence, Reliance Industries is also compensating the tax burden for these small shareholders, and hence they are paying the 447 rupees extra. Now, if you reverse calculate at 1,362, the maximum tax liability would be at 35%, that is 477 rupees. So they are giving you 885 per share value, the 477 tax burden, and hence they have arrived at this 1,362 rupees value per share. Now, at 885 rupees value per share that ENY had valued the Reliance Retail business, the entire business is valued at close to 8 lakh crore rupees, which is largely at par with what the street has been estimating the value for Reliance Retail.
Sweet of them. They are really sensitive about the tax burden the retail investor would have to pay. But guess what? The calculation, this is one calculation. There's another calculation which everybody is talking about. How did the company think about valuing the OFS price of Patanjali at 18% discount? That is another valuation which is being spoken about, and Vinny is here to talk more about that. FPO in a roaring move, the market of course is cheering, but Patanjali is locked on down circuit.
Absolutely. So, in this latest OFS that they've planned, now let's not forget that what this OFS is, they're looking to sell up to 7% of the stake. It's going to be 13 July, 14 July. And additionally, 2% stake also they would sell if there's an oversubscription coming in. But the discount factor, which you were mentioning, 18% discount. When you look at it, that discount is quite steep compared to what we've seen in the market from other companies when PE investors are existing in other companies. In the month of June, it has been in the range of just 5 to 10%. So this 18% discount that they're giving at the market price for the OFS, that is 1,000 rupees, is a very steep discount as compared to what we have seen in the industry and in the market as of now. Now, let's not forget, why is this happening? The promoter has to reduce their stake. They're currently holding 80% stake, while a public shareholding is only around 19%. They have to increase that 19% public shareholding to 25%. So that is why we're seeing this OFS that is coming in. Also, do not forget, in terms of, a bit of a pressure that comes in is that the company has not managed to deliver in terms of the guidance that they've spoken about as well. Firstly, in FY23, they said that earlier in the year, they said they'll get an EBITDA of around 2,500 crores. Now, when you include the other income of 300 crores, at the end of FY23, the company only managed to come out with an EBITDA of 1,577 crores. So clear miss in terms of the EBITDA. The targets that are for FY24 as well is in terms of around 2,800 crore EBITDA, and the run rate that we're seeing doesn't seem like they'll meet up with that as well. Let's not forget, when they spoke to ET now in somewhere around in March as well, they said that they will try meeting with the public shareholding, minimum shareholding that is required by the first half of FY24. If that works out well, that is something that we have something to watch out for. But as of now, this 18% discount is something that is very steep compared to the markets.
Right. Okay, Vinay, we'll leave it at that. In fact, lots of other stocks as well, which are in focus this morning. Look at what's happening to Federal Bank, for instance. Ahead of its numbers, the stock has taken a sharp knockdown. That stock is now lower by 4.25%. The results, of course, are awaited and they should be during the market hours itself. But that's quite a sharp slide that you're seeing on Federal Bank. Look at what's happening on Zomato, for instance. Look at the kind of spike up that you're seeing. It's almost hitting 80, 82, I stand corrected here. I mean, to think of it from those lows of 41, 42 thereabouts, it's doubled since then within no time at all. 81 bucks now on Zomato. A big move of nearly about 6% is what the stock is seeing. Look at BHEL. That's sitting on a gain of about almost 6% as we speak right now. So, the point being that while, yes, we are obsessing and, cheering about the Nifty actually hitting an all-time high, the larger bull market is at play in some of these individual stocks wherein, smart investors have found value at lows and they are seeing some massive returns come back.
Aisha, in fact, Anand Rathi, look at that 10% move coming in after the numbers. And that's the reason why I marked it saying that look at these market-related stocks and the earnings they're likely to post. Angel One is coming out with numbers today. Finolex Cables, another big 10% coming in out there. Data Patterns, 10%. So mid-cap, small-cap, some really good moves coming in even in today's session. Short break. Let's come back and more analysis and big stories on the other side.